everybody to WLM's very first end of financial year tax planning webinar. Let us make some introductions. So I'm Amanda Rogers and I'm joined by Charley Tarchichi. Charley and I have worked together for 12 years plus.
Is it 12 years? We've learnt a lot with each other, and we've come up with quite a lot of strategies that have been able to benefit our clients and maximize those tax opportunities. And obviously the tax legislation has changed quite a bit over the last few years, so there's that constant need for tax planning is important so that we can stay ahead of it and make sure that clients aren't really penalized with tax when we can kind of smooth things out over years where tax laws are changing and things are happening. So
anyway, let's get started. Tax planning, why should we do it? Well, the thing that I like most about tax planning is I get a chance to talk to you. I love talking to you, my clients, and I love hearing about what's happening in your life. And believe it or not, most of the things you talk to me about do have some sort of tax impact or a tax opportunity. You might be buying a holiday house thinking you can claim all these deductions, and so there's a few warnings about that. Or you might be planning on lending some money to your kids, not thinking that there may potentially be an opportunity there. So talk to your accountant. Make sure you talk to us at least once a year, and preferably before the end of June, or you do some sort of significant investment, because it's very hard to change a deal once it's happened. Now, the other thing is the ATO actually does insist that you do at least a little bit of tax planning if you've got a family trust, because a profit distribution minute needs to be prepared before 30th of June. So we have to have a bit of a look at the cash flows and the profits of the trust and have a bit of an idea on how we want to allocate that, and do that before 30 June. You might have spare cash sitting in your offset account. So that would be great potentially to utilise with government initiatives and superannuation. And so we do need to talk way up with you the benefits and the disadvantages of pulling money out of your offset account. Now, you may have a trading company or you might have an investment company. We need to look at how much cash you have withdrawn, to eat, spend on your kids, go on holidays. We need to look at that and work out, have you paid enough tax on those drawings? And then either top up the tax through more PAYGI or PAYGW, or plan how we're going to distribute the profits out. Or is there going to be a Division 7A line? Then you may have superannuation, either at you might have less than 500,000, and that actually provides an opportunity to put more money into super through the carry forward concessional contributions rules. Or you might have more than $2 million, which is still probably great, and we're not going to necessarily say, hey, pull it out, but we do start needing to plan and think about the Div 296 tax. That's the $3 million rule, and we'll talk about that a bit later. Also, if you are in pension mode, we need to make sure that you've taken your full minimum pension out. If you haven't taken that full minimum pension out, then your super fund may lose its income tax exemption on the earnings supporting that pension. All right, so there's still a couple more beautiful reasons why we do tax planning. One of them is, and especially for this year, is the rapid changing technology and payday super. So one, how are you paying your employees? Are you paying them weekly? Perhaps you might want to change that to fortnightly. Do you have zero auto super? Are you using the ATO clearinghouse? That's being abandoned by the end of the year. And do you have a default employer superannuation fund for your employees? If you don't have that, then chances are you're not able to pay new employees 7 days after you've paid them, and then you're going to get into trouble. So there's a little bit of stuff to talk about there. Then cash flow and tax. Cash flow and tax, those two seem to go hand in hand. We don't like tax shock. If we can estimate how much your tax is going to be for the year, you're not going to get this massive tax bill and go into sort of panic stations because you'd spend all your money on that fabulous international holiday. So that also gives a lot of people a lot of peace of mind knowing what those cash flows are. And then estate planning. No one really likes to do estate planning. We don't really like to think about that, but we do like at tax planning time just to at least tick off, have you got your super binding death nominations in place? Have you considered what's happening with all your new tax effective structures? New spouses, if there's new spouses. So there's a few things to just at least contemplate for a moment and plan to address in the future. All right, well, that's enough of hearing from me for the minute. Let us now move to Charley as he talks about tax planning the WLM way.
Yeah, so look, it's important that we do book in a meeting before the end of June, ideally somewhere around the end of April, mid to end of April, or even early May. It is a good opportunity for us to sit down and before then kind of have some sort of calculations put together with base scenarios of where we think things are going to land. And from there, we can then meet together and formulate an approach and update the calculations if needed, so that we can kind of maximize the tax scenario. As part of that, we would need some sort of estimate for business income and expenses, so that we can get an idea of where the profit is going to land before the end of the year and what we need to put in place to kind of mitigate any sort of tax shocks. The initial tax strategies will be developed before that meeting, and so we can discuss with you to work out things like profit distribution allocations, where cash can be drawn from. Is there enough cash to be drawn? Have we overdrawn from entities that we shouldn't be overdrawing from? And really having that meeting to discuss these strategies and where we can see any benefits or any sort of issues and update strategies before 30 June. And there are a lot of things that we need to make sure are done before 30 June, a lot of things that are kind of shrouded with legislation, such as signing of trust minutes, making sure superannuation contributions are paid on time, and as Amanda kind of touched on as well, things to do with minimum pensions. So yeah, that's really the things we've got to look out for as part of that tax planning approach. And then leading into that approach, we've a lot of our clients who do have businesses, there's a lot of things that we've got to consider and unravel before 30 June to make sure that our tax planning strategies are optimized and that we are looking at some of those things that all business owners need to consider. The first, and what Amanda and I both believe is most important, is having a good forecast in place. And it's funny, Amanda and I sat in a meeting not long ago with one of our clients who kind of likened this to relying on a weather forecast, where, if you get that forecast constantly wrong and you're planning a day on that weather forecast and it's wrong, you're going to be really annoyed and you're not going to be able to do what you need to do. And it's similarly with business. It is very important that we have those forecasts in place, because not only is it for business planning and knowing, which months of the year there is maximum profits or where there is a bit of a dip, but we do use these things for cash flow forecasting and even for tax planning. And we're kind of seeing a shift now, especially with the ATO, where they're requiring payments to be done in real time and more forward planning payments. And obviously we see that with the PAYG system for installments and also with withholding tax for staff wages, but also there's a shift with things like paying your superannuation in line with wages and all these sorts of pressures. And we probably will see stuff like this at a state government level as well. So it is important that we have these forecasts in place and we're monitoring these trends to be able to make sure there's enough cash flow and there isn't that cash crunch when there is taxes to pay, but also understanding and timing payments so that we're not overpaying installments or that we have enough cash to pay the installments that are assessed. So they're really the things that we've got to look out for. And ideally what we recommend is having a cash flow forecast that is in place for at least a 12 to 18 month period. And so that forecast needs to, give us a sense of where the business is tracking. And some of the tools that we use for that now are things like Sift or Join, or even we're looking into things like Claude AI to help us automate this process so that you guys aren't bogged down with the manual mundane task of having to update this manually. And really that's the main issues. And part of that is also looking at things like, have we overdrawn from the company? And if so, is that going to cause us a tax problem like Division 7A or shareholder loans? And making sure that that forecast factors those things in so we can budget for those in the tax planning and making sure we mitigate any tax consequences before 30 June. The next thing is that a lot of business owners miss is yes, we've budgeted for our profit figure, we've timed cash flow and payments of tax, but also there are a lot of things that give rise to indirectly to tax deductions in the balance sheet. And so it is important that as part of the tax planning, we are reviewing the balance sheet and just determining whether or not there are any tax deductions that we can kind of get out of the balance sheet. One of the biggest ones that we look for with small businesses is debtors. And a lot of business owners may not know this, but your debtor balance may not necessarily be accessible in the year that that debtor balance exists. So as at 30 June, if you have $100,000 in outstanding debts from customers, we can actually add that back to take it out of the profit figure and not pay tax on that at 30 June. Similarly with prepayments, if you've had to have a large prepayment for a massive insurance bill for the next 12 months, we can pick that up as a tax deduction and benefit from the tax deduction now, rather than having to wait whilst the expense is being incurred and amortize it over a number of years. So it's important that we do look at your balance sheet and time that. And we've seen, Amanda and I have seen this over the recent years where the corporate tax rates have changed, and it actually was better to defer that debtor balance to the following year when the tax rates have come down. And same with prepayments. I mean, if we're not keen to prepay something before 30 June, we might delay it to a year where the tax rates are kind of a bit lower and benefit from that. We'll bring it forward actually whether, we might benefit from a higher tax rate in 1 year versus a lower tax rate in another year. So they're things. So Amanda, what are your thoughts on that sort of strategy when looking at tax planning?
Well, the balance sheet is probably the most important place to start. We look at the balance sheet first, and then we look at the profit and loss. Without looking at the balance sheet, well, for example, sometimes we get you to, if you've got drawings, we often get you to pull that out in the balance sheet because that's not an expense, is it? That's you taking profit out of the business. So that's over there, and we've got to look at that, don't we? As well as obviously all these sort of fun things that are sitting there in the balance sheet.
Yeah, and that kind of leads to the next slide about Division 7A and drawings as well. So a lot of business owners draw funds, and sometimes all that money that's sitting in the company, we kind of see that as just one big pool of cash that belongs to us. But the tax law is quite strict on kind of segregating company cash versus personal cash, and any excess drawings from the company can lead to unwanted tax consequences. The worst scenario is we pull out too much cash and we just have to pay the residual or top-up tax on that amount that we've pulled out. Otherwise, the second worst case scenario is we drag out the tax over a number of years under the legislation requirements. But then what that means is if we pulled out that cash and put it in our offset account in our home loan, then we're kind of paying a bit of a penalty, which is the 8.37% interest on the amounts drawn that haven't either been repaid back or declared as taxable income. So it is important that we use the tax planning time to look at the Division 7A situation in the company and figure out, look, should we be paying tax on this now if we're going to be on a consistent rate of 47% from now to the next 10 years, or are we close to retiring? Should we put in strategies in place to park funds in a bucket company, which Amanda will talk about in a moment, or should we use a combination of strategies to figure out what the best way is to mitigate tax on overdrawing of cash from the company. So it is important that we look at these as part of tax planning, because sometimes, yes, there is a Division 7A problem, but if we've got a couple of bad years coming up and we know there's not going to be enough cash to draw out in a couple of years, we may say, okay, look, let's defer the tax on that, or let's put it in a bucket company, or do something there that can effectively extract profits without creating that large tax burden. And I know Amanda's got a number of good strategies that she does with things like bucket companies and helping to pay down those loans in very tax effective ways. Amanda, if you want to just touch on a couple of those.
Oh, well, they'll have to wait. I've got a pretty little example that I'll work through at the,
Yeah,
a little, in one of the later slides. Yes. Uh,
yeah.
but yes, well, it all sort of flows into from when we talk about our effective structures, Charlie.
Yeah. Especially with a lot of our trading companies that have their, or even investment companies where there's a family trust that's the shareholder of those entities. And I guess, there are three key scenarios on the next slide that will, or questions on the next slide that we can talk about that are kind of common questions that come up with clients. And I know, Amanda, these three are kind of prevalent. When we do the tax work and especially around tax planning time. And I guess the first question that usually comes up is, why do you have a family trust and what is the benefit? And, a client coming to you asking for advice, what do you believe would be the best answer to that question?
One of the things I do find is that I thought I've had this great meeting with a client. I've explained exactly why it was so good, such a good idea to have a family trust. And they've gone, okay, fine, I'll have a family trust. And then maybe 3 years later, we're busy doing our tax planning and they have no idea why they've got this family trust. Because it is a fairly complex thing. It is a weird sort of structure. But generally, when we meet you and we say, hey, like a family trust would be good, that is because there might be other members of the family, or even if there's no members of the family, I'm conscious of this bucket company structure, which is just a company really, but basically sharing investment profits, trading profits across family members to keep the taxable income lower, to reduce your tax bill. So that's generally why we talk about it to begin with. Of course, the ATO would be horrified if they thought that was the only reason that we were doing it. And so there does need to be other mechanisms or other reasons to have a family trust. And it does provide asset protection. And so that's also a really good thing, and it's also it is a good tool because I try and do my family budget. So, well, you get money out of my family trust, and when that's gone, you don't get any more money, and that's so it can be a tool like that. It can be. And it certainly can be a method for estate planning as well, because it actually lies outside the will. Anyway, we'll talk about that a bit later.
Yeah. So, Amanda, can you retain profits in a family trust? I guess it's black or white, yes or no?
No. But that is a confusing thing. And I'll try and illustrate that later. I'll show how profits flow through a family trust to somewhere else. And so that can be a difficult sort of concept because companies' profits sit and they pay company tax and the money can just sit there forever. Individuals, money gets into our bank account, it sits there forever until we spend it. But in a family trust, it flows through the company to the trust, out to the individual, or maybe it just flows into the family trust but goes straight out to the individuals. So the only times family trusts pay tax is if there's, been some sort of they couldn't make a valid trust distribution or some other sort of thing. And generally, when a family trust pays tax, it's at the highest 47% marginal rate.
So, Amanda, I guess, this is very prevalent with a lot of our clients, but, there might be a mum and dad situation with a few kids and there's been a windfall of profit that's had to come out of the company. And we've decided to, for one reason or another, to use another investment company for that repository of funds. Now, the profit share goes to the company, but they pull out individuals pull out the cash and put it on their home loan. What happens if we do that? What kind of are some of the things that we see?
So effectively what has happened there is the company has now lent you the money, okay? If the trust makes a profit distribution to the company, then that money belongs to the company or the bucket company or any other company. If it makes a profit distribution to there, it belongs to the company. And the ATO rules are sort of very insistent that that cash should flow over into the company. If it doesn't flow to the company and it flows to you instead, then you have effectively borrowed money from the company. And then that's why Division 7A kicks in. Fortunately, we do have 2 years. So there's the first year when it makes the profit distribution, and that's created what we called an unpaid present entitlement, and that's actually not a loan. And so you're fine for that year. Then the next year it becomes a loan, and well, you don't have to repay that loan until almost 12 months later. So we have got 2 years to scratch our heads and think about how we're going to deal with it. But yes, if you distribute profit to a company, that's not your money, not yet.
Yeah. And I guess, that kind of leads into the next slide as well, where common structures for mum and dad groups involve a combination of corporate structures owned by family trusts. So the benefits of a family trust, the first and foremost is what we try and do is keep that wealth within the family, mainly tax effectively, but also making sure that, if there are funds used for discretionary expenses, it all is kind of captured within that trust. Now, previously, what was happening was a lot of accountants were preparing their trust minutes or doing the accounts for a trust, and they're trying to just purely maximize the tax position, and that was it. There was kind of no rhyme or reason other than a tax benefit, which for, it isn't necessarily a very bad thing, but the ATO, I guess, as part of the legislation, wants to ensure that that isn't the main reason that this is done. They want to see the monies going to the beneficiaries that have been made presently entitled to that profit. Now, Amanda did touch on a 2-year time frame for companies, and that, the importance of cash going to companies because of things like Division 7A and other tax issues. But also, these tax issues are prevalent with children. So if we are distributing to a child, yes, Division 7A doesn't apply, but there are other aspects of the tax law that would apply, such as Section 100A. And so what the ATO is trying to do is, okay, you've distributed $10,000 each to your children. Have they received the cash? Now, it doesn't have to specifically be a lump sum payment, but you need to ensure that over the next 2-year time frame that Amanda's mentioned, that they have been seen to receive that. Now, that could be through board, incidentals, education expenses, a raft of expenses, but we need to demonstrate that. Now, if there is some sort of a reimbursement from that aspect, it is ideal that as part of the tax planning, we prepare a beneficiary acknowledgement, and we ensure that that beneficiary acknowledgement is signed off to say that the beneficiary has received these expenses in lieu of the a lump sum payment being paid out of the trust. So it is important that we use the tax planning opportunity to assess this situation and make sure that's done. Similarly, we may want to distribute $40,000 in profit, but haven't paid out that cash, but we know a family holiday is coming up that's very expensive, or the children want to buy a home and need some money for a deposit, etc. We can factor those in over the next couple of years. Other things are things like asset protection. So trusts are good for asset protection. Yes, Amanda mentioned it doesn't form part of the will per se, but it is still a good mechanism to protect assets and have shares in a trading company owned by that and protected with a corporate trustee and stuff like that. So family trusts do work well from that regard. And utilizing individual family members' tax-free thresholds, again leading to the first few points, but again making sure that cash is following that step. So the next thing is looking at bucket companies and how to kind of utilize the bucket companies, which Amanda sort of touched on. But Amanda, did you want to mention anything else about the bucket companies in terms of rainy day cash or anything you?
Yes, but that will be the next slide. So before I go to that next slide, we just want to remind everybody that we will also review the trust deed before we get excited about the profit distributions. I mean, most of the trust deeds that we set up allow us to distribute to trustees, allow us to distribute to corporate beneficiaries. And when I say corporate beneficiary, I mean bucket company. It's sort of the same thing. If your family trust is buying land, then you want to make sure that trust deed does exclude foreign beneficiaries. So please do talk to us before you rush out and buy land in a family trust, because there's all sorts of considerations, not just your trust deed, but also land tax. Also, if it's a very old trust, they will vest. They don't last forever. They last, I don't know, about 80, 90 years, something like that. Anyway, and that can create a tax problem too when it vests. So we always like to make sure that those old trusts aren't coming up to vesting date. We tend to stream franked dividends and capital gains. Most trust deeds sort of have some allowance for that, so I don't usually find too many problems there. And so, so with individuals, we have to look at them before we make a profit distribution to them. We have to consider HECS debt too for kids. So that, but then sometimes maybe that's a good thing. Maybe, okay, sure, they end up paying the same tax as you, but at least we're paying off their HECS debt. So that, that is a decision that we, make together with you before we rush around distributing profits to them. Okay, and then after we've used up all the individuals, the kids only took 20k each. There's still another 80k each. Mum and dad, they've made 250,000. They're going to pay an extra 15% tax on their superannuation. Perhaps we should make a distribution to a bucket company. Maybe there's even some spare cash that we can put into that bucket company. And that now leads on to bucket companies. Yes. So a bucket company is a potential beneficiary of your family trust. Now, it's not just a tax thing, so we can actually put the money into the bucket company, and that is beautiful. So I do have a few clients that do use their bucket companies for investments, and they actually also even own property inside their bucket company. So they own shares, they own property. Interesting, if the federal government does bring in that change of rules regarding the 50% CGT discount, bucket companies are probably going to become quite popular for owning properties. But anyway, let's watch that space. So if we don't pass the cash across into the company though, then as previously mentioned, that will cause Division 7A issues in about 2 years' time. We are currently watching and waiting the outcome of the Bendel case. And this is a case that involved a family trust making a profit distribution to the company. It didn't pay the money out to the individuals. It kept the money in the trust and invested in the trust, and didn't want to be liable for Division 7A issues. So we're watching, see what the outcome. The High Court hasn't released what they think, so that will be interesting. But basically they're saying an unpaid present entitlement isn't a loan, which is totally not what the ATO says. So it'll be interesting to see what happens there. So the advantage of bucket companies, yes, it's another place to invest and cap the tax at 30% until you're ready to draw it out. And if you wait until you retire or you're having a year where you're not earning any income, you actually get a refund of that tax back. So that's really nice to get a refund. For your kids, it can become a bank of mum and dad. You can use that to lend money to the kids, and they have to pay the Division 7A loan interest potentially, and you can lend it over 25 years, just like a bank. And yes, it can also be an estate planning tool. Maybe you control the family from the grave, and you can say, well, hey, the grandkids are going to get all the money that's sitting in my bucket company, because I know those rascally kids of mine are going to spend it all and not look after their their children. All right. Now, we mentioned earlier, Charlie's very keen for me to demonstrate this particular example, and this shows how profits flow from a trading company to a family trust, and then, and what the tax differences or variances are compared distributing the profit to mum and dad versus distributing to mum and bucket company. So in this scenario, we've assumed mum's earned a salary of $150,000, and let's just say dad also earned a salary of $150,000. And they know in 26, 27, they're going to hop in their caravan and go around Australia for a good 6 to 8 months of the year and not earn any other income. They've, leased out their business to someone to manage for them. So, they're off on this big trip. So we know we can actually get some tax back if we use the bucket company. So now the trading company, it's made a net profit here of $150,000. It's paid a dividend now of $150,000, so it's paying all its profits out, which is fairly unusual. We don't normally recommend that to our trading companies, but that's okay in this case. So it's all gone to the family trust because the family trust is the shareholder. Now, we've made a distribution before 30th of June. We've said 50% of that's going to mum and the other 50% is going to the bucket company. Now, the franking credit, so that's the tax that's been paid by the company. So if you look at the company, you can see that it paid $50,000 tax. So 50% of that tax gets added to mum's income. It also gets added to the bucket company's income. Then, so that's made mum's income now 250,000. We calculate that tax. Well, I've just distinguished the different taxes there, but we calculate the total tax on that 250,000, which in this case, I think that's 78,638,000 or something like that. And then it gets a credit. It gets a franking credit. So there's a tax on salary, then there's a tax on the distribution, then we get our franking credit, so we actually get a credit for some of that tax being paid. So in the end, mum has a tax bill of 16,800 because she'd already paid her taxes on her salary. So she's got to pay 16,800 tax. Now the bucket company, it gets its $75,000. The franking credit gets added back on. We calculate the tax on the 100,000. Being a passive entity company, it gets taxed at 30%. We get a reduction of the franking credit of 25%, and so it does only pay 5,000. So that's a lot less than mum. Mum's got to pay 16,800. Bucket Co has to pay $5,000. So there's a tax saving for that 25-26 year. Then come 26-27. Because mum and dad haven't got any other income, we then pay a dividend from bucket company across to mum and dad. They haven't. Well, actually, mum's probably taken all the cash already because she had to buy a caravan for their trip. So there's no cash. They've taken it all already, but we still put in their tax return a dividend. So it's a paper dividend, 35 plus the franking credit of $15,000. That's the tax that was paid by the bucket company for 25-26. See that $30,000 there. Then they get the benefit of the franking credits, and there they get an $18,000 tax refund in 26-27. No money's happened, they just get a refund. So overall, that scenario gives us a total tax liability for those 2 years of $53,000. Now, if we didn't distribute any money whatsoever to bucket company and we just did mum and dad in 25-26, their tax bill would have been $83,600. So this is why we try and use bucket companies sometimes. Very different scenario. If for the next 10 years, mum and dad are going to earn $250,000 each, then the Division 7A stuff actually doesn't work. And we're just going to say, hey, you've got to pay the tax. All right. So I think we're on to you next. Yeah. Hey, Charlie?
Yeah, so the final thing is, as I've already mentioned earlier, is the other beneficiaries that we have available are the adult children. The main thing here is that we've just got to ensure that they are receiving the cash. And similarly, yes, we get the benefit from the marginal rate, similar to having a lower corporate tax rate if we use a corporate company. But in either scenario, whether it's a bucket company or adult children, the cash does need to flow there. And if not, then we've got to put strategies in place to make sure that things are done to not create any other sort of tax issues or tax burdens. And that's pretty much it. And so, the next thing is the year-end must-dos. And this is just kind of a little checklist of what we kind of like to look out for as part of the process of doing the tax planning, and after we've kind of put together some sort of scenarios for profit for business and working out the right structures. So the first thing is federal budget in May. So it's important that we do wait for that budget as well and incorporate that into our tax planning, because sometimes the budget is quite placid and there isn't much happening, but sometimes there is a raft of legislation that does come into play and can impact us. Carry forward concessional contributions. Amanda touched on that a bit earlier, but if your balance is under $500,000 and you want to start ramping up your super, it can be tax effective for you because you can go back and make any catch-up contributions for any caps that you didn't maximize in the last 5 years. Electric motor vehicles. This is Amanda's new hot topics that she's going to present next. But yeah, she'll show the tax benefits and, kind of utilizing the concessions available at the moment by the federal government for electric vehicles. Bringing forward expenditure. So if you're going to have a massive repairs and maintenance bill, trying to get that invoice in before 30 June. Again, it doesn't have to be paid before 30 June as long as it's incurred. That's kind of what we look for. Donations, if you're looking to make donations, make sure that deductible gift recipients that can receive tax deductible donations. Defer revenue. So if don't need the cash right now and you want to delay the receipt of payment from your customers, look at strategies there. Expenses in advance, prepayments, a big insurance bill is just about to come, put the invoice through the system as a prepayment and we'll pick it up. Pay super guarantee for employees. Now, a lot of people don't know this, but just because you've incurred a liability for super does not mean it will be taxed before 30 June, doesn't mean it will be tax deductible as part of that financial year. You must pay that super before 30 June to be able to claim a tax deduction. Otherwise, we will claim it in the year that it is actually paid. And Amanda, I know you've got a nice diagram on the next slide. So if you just want to run people through the EVs and your, very beautiful table that you've created.
Okay, so I actually did get AI to help me do this, Charlie. So I asked AI, hey, compare please the electric vehicle on a novated lease that's worth 80,000 compared to a hire purchase or a chattel lease for $60,000. And of course, a hybrid doesn't get the tax benefits of 100% business use, that special exemption from it was a fringe benefits tax exemption. So you will only be able to claim 60% of the deductions in this hybrid scenario. And so I compared that, but it's 20K less than my electric vehicle. So as you can see here, my finance and lease costs for the novated lease are certainly larger than what they will be for the hybrid car. My running costs cheaper because electricity is obviously cheaper than petrol. But then I get this 100% pre-tax salary sacrifice deduction for my novated lease. But for my hybrid, well, we're only getting the 60%. So the deductible amount is much less. Now, I've been very conservative in this scenario. I've only used a 39% tax rate, but if you're on the 47% tax rate, the savings are even, substantially greater. So even though my electric car, and I did just get one last night, everybody, so that's why I'm very excited. But it wasn't 80,000. It was, but anyway. But anyway, we have, certainly made these sorts of savings, and your effective annual cost is certainly a lot cheaper with an EV compared to the hybrid. If you are a trading company, like it's just a mum and dad company, you don't need a novated lease. You can get your electric car through a chattel mortgage hybrid, a hire purchase chattel mortgage lease for your electric vehicle. It won't cost as much as a novated lease. So the novated lease is really just for people who are employees and not, don't really have an ownership or a sharing, or maybe they're a business partner. There might be 4 or 5 different business partners. You might be better off with a novated lease in that scenario. Okay, what's what with super? This is me again. All right. So, yes, there's lots of great tax opportunities and things to watch out with super. All right. So, first thing is, what is your member balance? So, if you've got less than 500,000 and you haven't been making your maximum concessional contributions each year, I think we've got 30,000 at the moment is a cap. So, and then last year, I think it was it 27,500 last year?
30,000 as well.
Yeah, 30,000. Yes, that's right. What year is it? 25, 26? Okay.
26.
Okay. So, but anyway, if you haven't used up your full amount for the 25 year and the 24 and going back to 22, the ATO tells us. We can log into the ATO and see how much cap you've got left. So you might have $10,000 or $15,000 of contributions you could have claimed, but you didn't. And we can claim it all in 1 year. And that is very nice for your tax position.
Yeah, so Amanda, I've had clients ask me whether it's their 500K as at the date we give them the advice, or when is the 500K assessed?
Well, the ATO assesses it, but it looks at your closing balance. I think it looks at your opening balance for the year. So it would be looking at your 30 June 2025 balance. So we look at your 30 June 2025 balance, and it will tell us, yes, this client is eligible for their carry forward concessional caps, and then we can advise you what that is. If you have a self-managed super fund and you haven't lodged your 25 tax return yet, then we can't trust the ATO. We will have to look at what's happening in your self-managed super fund. Yeah. So are you age 60 and not working more than 10 hours per week? You could start a full pension and get tax-exempt earnings in your super fund. So your super fund will pay 0% on all the profits that it makes. If provided that we are able to put the full amount of your super into pension. So the maximum amount to start a pension in 25-26 is $2 million. So if you've got a bit more, the rest will stay in accumulation, and that will still just keep paying tax at 15%. Look, it's still the most tax-effective vehicle to have investments. Still better than my favourite bucket company. So we do, from a tax perspective, and I do have to be very careful because we are mere accountants. We do not have an AFSL, so we can't give you advice on financial products. So please try not to squeeze us too much for financial advice. And but we can certainly advise on the tax advantages. But we do work closely with financial advisors. We can refer you to a financial advisor, or you can pick your own, and we're quite happy to work with them too. Anyway, but nevertheless, they often come to us asking what the tax implications are. So we're all over it. So Div 296 got legislated in March. So that just means if you've got $9 million in your super fund, chances are you might want to think about pulling some of that money out and putting it in a bucket company, because once it gets to $10 million, any profits over the $10 million will be taxed at 40%. At the $3 million, so if you've got $3.3 million in your super fund, and also it doesn't start until 1 July 27 either, so you've got a bit of time to worry about it. But let's say 1 July 27, there's 300,000. So that works out as about 9% of your overall super fund. And let's say your profit was, I don't know, let's say it's 300,000 as well. So 9% of that 300,000 will be taxed at 30%. So maybe 3,000 in tax, nothing. Okay, so it's not something to get too stressed about. So if you're nearing the age of 75, you can't make any more contributions other than employer contributions or the downsizer contribution. You have 28 days from the time of turning 75 to make a contribution. Minimum pensions. You can't make non-concessional contributions if your transfer balance cap, isn't that a fun word? But that actually is referring how much money you can put to start a pension. So at 25-26, your transfer cap is $2 million, because that's how much you're allowed to put into pension mode. So if you've exceeded your transfer balance cap, you can't make any more non-concessional contributions, but you can still make downsizer contributions. We strongly encourage our clients, especially those who are in pension mode, not to pay for their accounting fees or any expense that's related to the super fund, their investment fees, personally, because that's either a reduction in your pension or a super contribution, and that can create problems. And as previously mentioned, if you don't make the minimum pension, you will lose your tax-exempt status. We can, if there is a shortfall, I think there's 1/12 of the minimum pension amount we can sort of put to sundry creditors or sundry debtors or whatever the situation. But really, you don't want to risk that. Let's just make sure you've pulled out your minimum pension. And yeah, it's important for us to review those cash transactions each year. All right, what else have I got to talk about? Okay, we're almost nearing the end.
Estate planning.
Yeah, no. Last but not least, we do need to sort of consider the implications. So you've got all excited, you've got your bucket co, you've got your family trust, you've written your will, say everything in my family trust and my super fund and my bucket co all go to Joe Blow. Well, that won't actually be valid. Okay, the will is actually about you personally, what you can leave behind of your personal assets. So what you might own is a share in the bucket company. So your share, your part ownership of that bucket company, yes, you can say who that goes to. The family trust, that lies outside completely. So you may mention in your will who you want to be the appointer or the trustee, but you can't actually say what happens to the assets inside that trust. You can't say that. Similarly, the super fund deed has its own sort of rules about where the money goes. You can override that with a binding death nomination, but it still has to go to a valid dependent. So you can't do a binding death nomination and say, hey, I want my mate Charlie to get my stuff in super. Okay, I like Charlie very much, but he is not a cis dependent of me, so I can't give it to him via my binding death nomination. If I want him to get it, what I will do is, So if I do want Charlie to get it, I just write him in my will. I say Charlie gets, $100,000 out of my will, and then I say in my binding death nomination, can all my super go to my estate? And then the estate can do whatever. So anyway, what was that? Sorry, Charlie?
We've got this on tape that you're giving me $100,000 in your will.
That's just an example.
Yeah. So Amanda, obviously you and I have dealt a lot with estate planning, and we've seen a lot of clients that have bucket companies and who have passed away with a number of beneficiaries, children that inherit those bucket companies and set up testamentary trusts and have those shares then owned by the testamentary trust, versus other clients who might have passed away with a family trust and have all their wealth in the family trust. I mean, what do you see as a lot of stuff that we implement that might preference one sort of thing versus over another, in terms of bucket companies versus family trusts?
All right. So yes, I do have some beneficiaries who get very upset because mum and dad were very clever and didn't make themselves pay tax, but it has passed the burden on to their children. So if the money and the assets are sitting in the bucket company, then the children will have to pay the top-up tax to pull the money out. And especially if they pull all the money out in one go, there will be, they'll effectively pay 47%, or maybe there's some 50% CGT discount. Oh, no, they won't. Because it's just a dividend. Yes, so bucket companies don't get the CGT discount. So, yes, so it can, so they can be a bit of a shock. But at the end of the day, it's your money. You look after your tax, but the kids worry about that later. And we can do clever things with the kids. So what we can do is we can utilise the Division 7A loan rules, eke out the cash to them each year, and then that way they actually get a refund of that tax. So it actually works out better for them. They can get a refund, and also they can have their own bucket company. So I did have a client where each client had testamentary trusts. So yes, so this is a good time to at tax planning, if you are thinking about your will, to get your head around testamentary trusts. It's probably a bit much to talk about it now, so I'm probably not going to go into it now. But yes, it is effectively another family trust that is just created on death. So yes, if you'd like to talk to us a bit more about that, I would be very happy to, or Charlie would be very happy to have a meeting.